How to get rich from dividends. That's what we're talking about today, guys. Welcome to the channel. My name is Domenico. Today we'll be going through 4 steps to teach you guys how to make dividend income and how you can get rich from it. So first, we're going to be going through what dividends actually are. We're going to be going through the definition of what a dividend is, and we're going to be explaining to you guys through a fictitious company example how dividends actually work. Next, we'll be going into why dividends can be vital to add to your portfolio and how they can benefit your portfolio diversity and protection against downturns. Next, we'll be going into how dividends can make you rich. We'll be going through certain strategies on how to make dividend income and how you can increase your dividend income over time. And then lastly, we'll be going into my opinion on having only dividend stocks, okay? So there are people that invest only in dividend stocks, so we'll be going into my opinion on that and if I think you should diversify from only owning dividend stock. So let's get right into the video. Just before we get into the video, guys, don't forget to leave a like and subscribe to the channel down below if you do enjoy the video. It really helps out with the YouTube algorithm, getting my videos out there so I can create more of this great content for you guys and teaching you about the stock market. With that out of the way, let's get right into it. All right, so let's start off with some business basics. So this is how a company makes money, okay? So first, they have some revenues by either selling a product or a service, okay? So this money comes in. Next, this money goes to 2 different places. It either goes to expenses or profit. Now, expenses include everything from payroll, which is paying the employees or paying drivers or paying anyone that works for the company. Then you have taxes on the revenues. Then you have the rent. Let's say you have physical locations or warehouses. You have to actually pay the rent for those places. And then you have product costs. If you're actually selling a product, you have to actually purchase that product itself. So that's the cost of the actual product, and those are all the expenses, okay? So from that revenue, the expenses are subtracted. And now the rest of the money goes towards the profit. Now, the company can decide where this profit goes. It has 4 options, basically, in general, where this money can go. It can either go to dividends, which is paying out shareholders, and we'll explain this further later on, which is basically what the video is all about. Then we have R&D, which is research and development, making new products, coming up with innovating the products to become even better, more efficient. Then we have investments such as building new buildings or purchasing new buildings, warehouses, locations, all that stuff. And then we have share buybacks. Basically, the company buys back its own stock, so there are less shares outstanding. So that means each share itself, it has a larger portion of the company behind it. So let's say the company has 100 million shares. It buys back 50 million shares, which is really unrealistic to buy back 50% of the shares, but just for the example, if the company buys back 50 million shares, that means that each share is worth 50% more than it previously was. It owns 50% more of the company than it actually did beforehand. So share buybacks can be very, very crucial, but anyway, so that's where profits can go towards, okay? So that's basically where profits can go towards. So now we'll be discussing the dividends part, so how that basically works, and some terminology regarding dividends in general. So let's get right into it. Okay, so let's start off with an example of a fictitious company, ABC. So this company has a stock price of $10 currently and is divided into 40 million shares outstanding. So basically, 40 million shares outstanding basically means that the company is divided into 40 million pieces. Each piece is 1 stock. So if you have all 40 million stocks, that's the entire company, okay? So basically, this company this year made $200 million in revenue. They had $100 million in expenses to pay out. Basically, that means that when you subtract them from each other, you get $100 million in profit or a net income, okay? That's basically the same thing. So let's say the CEO decides, okay, this is how we're gonna split up the profit, because every year they have to, or every quarter, they have to decide where they want to put this profit. So he says, I wanna put $20 million towards a new warehouse. They want a new warehouse. So they buy a $20 million new warehouse in a certain location. They put $40 million towards research and development, towards innovating for a new product. They want to come out with a new product. So they put $40 million towards the research and development of that product. And lastly, they pay out $40 million in dividends. So since there's 40 million shares, they pay out $40 million. That's $1 per share, okay? So they pay out $1 per share in dividends this year. If they pay out $40 million in dividends out of the $100 million in net income they made, Okay, so out of the $100 million profit pot, they paid out $40 million in dividends. So that's 40%. They paid out 40% of their net income in dividends. That's called a payout ratio. Now, when looking at a stock, I always look for a payout ratio less than 60%. The payout ratio basically tells you how sustainable a company's dividend is. So if you have a company with a payout ratio that's really, really high, let's say there is a downturn in the market and the economy slows down. Well, the company will be making less sales and therefore the net income will likely decrease. If the net income decreases and they're at, say, a 95% payout ratio and their net income decreases, they'll be paying out probably more in dividends than they're actually making. So they're going to have to either take out debt to pay that dividend, or they may have to cut the dividend, or they may have to decrease the dividend. So you really don't want to be in that situation. So I always aim for investing in companies that have a maximum of a 60% payout ratio, meaning they're only paying out $6 for every $10 they make in profit. Okay, so that's my strategy for payout ratios. And then we have the yield. So basically the yield is they're paying out $1 per share, okay, and the share price currently is $10. So $1 dividend out of $10 price is 10%. So that's the yield of this company. All right, so why might dividend paying stocks be vital to your portfolio? So in the stock market, by owning specific stocks, there are only two ways to really make money in the stock market. Number one is share appreciation. Basically what this means is selling the stock for a higher price than what you paid for it. If you paid $10 for a stock, you're going to sell it for $15, $20, $25, $30, $40 a share. The other way is dividends. Now, dividends is the part of the profits that the company pays out to its shareholders. Now, there are a few problems with share appreciation. So there are certain stocks that run flat for certain years. So I can name many examples of certain stocks that stayed flat and did not really move for 5, 10, 15 years even in the stock market. So in this case, there is no share appreciation because the share hasn't appreciated in value. The next case is in recessions. In recessions, the entire market in general usually decreases in value. In this case, there is definitely not share appreciation. If anything, there is share depreciation. So if you buy a stock for $10, it'll probably reach $7, $8, around there. So it'll be worth less than what you paid for it. So in these cases, the only way to make money is with dividends. If you own a stock that does not pay a dividend during these periods, you will not be able to make money during these periods. Now, with a dividend paying stock, even during these periods, if you have a sustainable dividend payer, well, they'll still be paying the dividend. So you'll still have income coming in no matter what the share price is at that point. So let's say you own an Apple or company ABC that we just gave an example about a moment ago. If they pay $1 per share per year, you're making $1 per share per year in dividends no matter what the stock does. If the stock goes up, down, sideways, no matter what, you get that dollar per share. So dividends are very reliable if it's from a sustainable company, and you can just rely on that passive income to come in every single quarter. So that's why I believe every portfolio should have at least some sustainable dividend payers for the long term. Just in case something like this happens, you still have some dividend income coming into the door. All right, now let's get into my opinion on only owning dividend stock. So why am I personally against only investing in dividend paying companies? Well, here's the truth of the matter. Dividend payers are usually established. They're already well established companies, and they're usually very low to no growth at all. So if you're looking to make a lot of money in share appreciation, it probably won't happen with a dividend payer. These are just some examples I got off of the top of my head of companies that you wouldn't even be able to invest in were you to follow this philosophy. You wouldn't be able to invest in Facebook, Tesla, Amazon, Uber, not even in Berkshire Hathaway, not even in Warren Buffett's company. Warren Buffett doesn't even pay out a dividend. So the thing with dividends is this. Yes, you do get paid out every quarter a certain amount of money consistently, and usually it is sustainable if the company is within a certain ratio for the payout ratio. But generally speaking, dividends are relatively safe. So when you do receive a dividend, you can do whatever you want with that money. You can reinvest into other stocks, you can buy yourself something, whatever you'd like. Usually I'd recommend just putting it back into the market, purchasing another stock or that stock again, but in general, you want to reinvest the dividend. Now, what can happen is, let's say with Berkshire Hathaway, why doesn't Warren Buffett pay out a dividend? Well, Buffett has a track record of receiving 20% annual returns on his investments. So if he would pay out the company's earnings to the shareholders, that money would be long gone, and Berkshire wouldn't be able to get any return for that investment. They would just be pushing that money out of the company, off the balance sheets, and into the hands of the shareholders. Well, instead of doing this, Buffett decided that he would like to return the entire earnings of the company and reinvest them year in and year out. By doing so, he receives about 20% return on equity. If he were to pay out the money to shareholders, they would probably just receive an average of 8 to maybe 15% a year. So by retaining the earnings, Berkshire is actually doing better for the shareholders than they would if they would be just paying out the shares. Now, why do I believe certain companies shouldn't be paying a dividend? I believe that there are certain companies that should not pay out a dividend no matter what. So a company in decline, they should retain those earnings and try to build up or turn around the company if they see that that is a possibility, rather than just paying out the dividend. I see time and time again, for example, Macy's. Macy's pays out a massive dividend, okay? But Macy's is in a massive declining market. They should find a way to innovate and to try to invest more into selling online rather than just paying out like a 7% dividend or something crazy of that sort. So they should just cut that dividend completely and just start investing into their actual company rather than paying out the dividend and watch their business in decline. Now let's take Uber for an example. Uber does not make a profit currently, but let's say they did. Would I prefer they pay out the dividend, or would I prefer they retain the earnings? Well, if they pay out the dividend, they will take out that money from the balance sheet and give it out to shareholders. I can do whatever I'd like with it. But then again, I want the company to expand. I'm a long-term investor. I want the company to build out, grow out, and 5-10 years from now, the company will be worth 5-10 times what it's worth now, because they invested heavily into the business and retained all those earnings, and they were able to get a much better rate of return than I could have gotten were they to pay out that dividend to me. So in general, I believe that the companies should retain earnings as long as they'll be able to achieve a greater rate of return than I will. If I can get a better rate of return than the company can, I'd like them to pay me out the dividend. These are just some examples. Tesla with the automated vehicles. Why would Tesla want to pay out some dividends if they can just retain the earnings and use it for research and developments, using the money to develop a better battery, the 1 million mile battery, for example? They're going to have to develop that product, and to develop it, they need lots and lots of capital. Why would you give that capital away to shareholders when you can use that? That's valuable capital that you can use to expand the business further. So in my opinion, I do believe that companies that are able to utilize the capital effectively to expand the business further should retain the earnings, and they should use it to grow the business overall, rather than paying it to shareholders to attract certain dividend investors. By investing only in dividend companies, you are limiting yourself. I think about 60% of the S&P 500 does pay dividends. But how about the other 40%? Just by only investing in dividend paying stocks, you're already eliminating 40% of the market of the possibilities of investments. But usually the ones that don't pay dividends are the ones that will grow the fastest. So if you are a growth investor, there is no way you can only invest in dividend paying stocks, because usually those are the stocks that don't grow at all. So in my opinion, that is why you cannot only invest in dividend paying stocks. You need to have a balance between dividend paying stocks and growth stocks that do not pay a dividend and that retain their entire profits. But in general, I'd like a balance between share buybacks, dividends, and research and development altogether. I don't want a company to be paying out 90% of their profits into dividends. That makes absolutely no sense for me personally, because I want the business to grow. I don't want it to stay stagnant. The good example of that is Macy's. All right, so the last thing I want to explain to you guys is the drip. So the drip is a very important concept to understand, and it's a strategy that you guys can use to make yourselves a lot of money compounded every single year. Dividend reinvestment plan, that's what it stands for. Let's go through an example and I'll show you how powerful this actually is. So let's say a stock is at $15, okay? You own that stock and it pays out a $1 dividend per share per year, okay? Now you have 1,500 shares and it pays out $1, so $1 times 1,500 is $1,500 divided by $15 stock price, meaning you can buy 100 shares with the dividend you receive. What the drip does is it automatically repurchases shares with that amount of money without having to pay a commission, of course. So let's say you receive $1,500, the stock is $15, you can buy 100 shares. It automatically repurchases 100 shares for you in that company. Now, the next year when you're paid out $1 per share, you're no longer going to receive $1,500, you're going to receive $1,600 because now you own 100 extra shares. And most likely the dividend will likely increase because a lot of companies do grow their dividend over time as their profits increase. So instead of $1, it might be $1.10. Well, you're then getting $1.10 times 1,600. So not only are you getting more money, but you also have more shares. So, and this compounds. And then the next year you're not going to have 1,600. You're going to have 1,720. And then you're going to, so it keeps growing along with the money. So the drip definitely takes advantage of compounding. And compounding is very, very effective. You can also go online, use a compound calculator. You see, put in a few of these numbers, you'll see how quickly the numbers start to add up, because you're making interest on the interest of the interest of the interest of the money. So you're making interest over interest over interest over interest. So basically these shares the next year are going to produce a few shares extra. So you're getting interest on the interest. And that's very, very powerful. If you look at Warren Buffett, that's been his secret. He compounds his money over time, and that's how he gets to, you know, like $88 billion at this point. So ridiculous, but you know, it's all through compound interest. So that's very important, and it's a very important concept in the market to understand, to be able to create wealth in the stock market. So that's about it for this strategy. Hope you guys understood. If not, just rewind it. I'm sure you'll understand this. It's not too complex of a topic, but it's very important that you guys understand how to make money using a drip and compound interest as well. So we have reached the end of the video, guys. I hope you guys really enjoyed and learned a lot about dividends in this video, and I hope you guys now know how to grow your wealth using dividends in the stock market for the long term. So if you did enjoy, don't forget to leave a like and subscribe down below. Just remember, guys, always keep a diversified portfolio with both dividend and non-dividend paying stocks to be able to maximize your profits within the market during a downturn or an upswing. No matter what's going on in the market, you'll be able to make some money. So I hope you guys enjoyed. Don't forget to leave a like and subscribe down below, but I'll see you in the next one.